Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Hello, everyone, and welcome to the Expansive CEO podcast. I am your host, Hannah Chapman, and this is another installment of Investment Friday. I am coming to you solo today. So Brad Haynes is working on some other stuff at the moment. So it's just me and the microphone and all of you lovely humans who are listening. Being recorded as usual on the Thursday before. So Thursday, October 3rd. It's currently 3:53 p.m. as I am looking at the clock right now. So everything I'm talking about right now is as of Thursday afternoon, going into release on Friday, October 4th. So one of the things that I wanted to talk about today, one market update, kind of what's happening with the markets. It is the first week of October. It is October 3rd again, release October 4th. And we've had a down week in the markets. The S&P 500 is down. I can even check the exact amount. This week, we're down about 1% since September 27th, so 1 week ago. And sometimes, right, the news can hype that up and you can feel like, oh, what's wrong? What's wrong? Something's wrong. We have to look for the thing. We have to look for the issue that's popping up because the markets are down. And a lot of times on this podcast, on the Investment Friday installments, we talk about those things that are going on. Okay. There was a spike in oil prices. Did that do it? Interest rates, the last installment we did of Investment Friday, we're talking about interest rates and how the Fed cut a 0.5% interest rate, and the market decided that meant, oh, we're going to take a dive for a little bit here. With that information, which was really interesting to experience. So, what do we do in those moments when over a whole week we've been down and we're down 1% on the S&P 500, which is one of our headline indices? Well, let's back it up a month, because over the last month, from September 3rd until October 3rd, that same S&P 500 is up 3.02%. And so even with that 1% drop, right, we're still up 3% over the last month. And so the first thing I wanted to talk about a little bit is what we call recency bias. And we have talked about this before on the podcast, but I want to just kind of hit it home again that recency bias is a really important thing to actually stop and ask yourself if you are in the midst of, taking a recency bias on whatever you're looking at. Is the way that things are going now always going to be the way they will be going forward? Because the answer to that is no. I can definitively say, right? I can say very confidently, no, things will not always go the way they have been going. Whether that's for the last day, the last week, the last 3 weeks, the last, several months. If we assume that tomorrow, next month, next year is going to be exactly like what we just experienced, we are committing that recency bias fallacy. And so for the moment, that's really all I want to say about that. Yes, we are down over the week, and this is a volatile time of year. We've talked about that several times, actually. Now, between now and the election, we have one more month left until the, presidential election. Till election day in the United States, which this year does include a presidential election, as we all have been talking about quite a bit. And we've talked about the volatility that we will likely experience, especially through this time period. So we are in the midst of this volatility, and it's okay. It's going to be okay. The market will recover. It likely, all estimates actually point to, even another 5% or so gain potentially over the rest of the year from now to December. And so just because we've had a bad, quote unquote, bad week in the markets does not mean that's the way it's going to continue to go over the next week, months, etc. In fact, over the long term, what we typically experience is pretty considerable growth. And so the next thing that I wanted to talk about today is I'm going to share my screen so anyone who is watching on YouTube will be able to see these cool charts that I'm sharing. This comes from our literal Wednesday call with advisors that Brad puts out for Juncture Wealth Strategies for our advisor team. And we go over, this really good information that I'd really love to share with you all. So this set of charts is comparing what we are experiencing right now and have experienced over the last, few years, especially to the late 90s. And, in a lot of ways, history doesn't necessarily repeat, but it rhymes. And so this is another example of that. So if we look at these charts, I'll explain them to you for anyone who's just listening. We're looking at about 1990 to 2000 on one set of charts, and then 2020 to 2024 on this next set of charts. So there's, it's not the exact same time frame, but again, if you go to YouTube and follow the Expansive CEO YouTube channel, you'll see everything there. In the late 90s, what were the things that were similar? One, the Federal Reserve was easing interest rates, and we were having, experiencing growth in our economy. Same thing that's happening now. The Federal Reserve is now easing interest rates. They plan to do so for another at least year and a half, with the goal being getting the rate down to about 2.5%. So that our federal funds rate is going to be around 2.5% by the time they finish cutting interest rates from about 5%. They've been around 5%. So we're in a period where the Fed is easing interest rates. Next, the US economy is quite strong relative to the rest of the world. And we have had periods where that hasn't been the case, right? So in the Great Recession, 2008 to roughly, 2010, recovery happened by about 2011. Things were tough. And things were tough globally, not to say that they weren't, but the US economy was really struggling through that period. So right now, the US is very strong relative to the rest of the world. Another really big similarity we've talked about in a few different ways on the podcast before is this innovation wave in technology. That technology is taking a huge leap forward. So what was it back in the 90s? Back in the 90s, it was the internet, right? So personal computers had been around for a while. I remember my family getting our first computer at home when I was probably about 5 or 6 years old. So this was 1989, 1990. Um, and that we had our personal computers, we had a printer, we had the dot matrix pages, you got to rip the sides off your pages when you print stuff. And we did not have the internet, but we had the computer, right? We could create documents, we could write things, we could make art in MS Paint, all that cool stuff. But we didn't really have the internet at that point. And so what was happening through the 90s, especially leading towards the mid to late 90s, the internet was really becoming a thing that was starting to change business. It was changing people's lives personally, but more so it was really coming into its own in the business world and making huge shifts. So that's where the dot-com bubble comes from, where technology prices were being bid up in the stock markets like crazy on the promise of they didn't actually have any they could have like very little revenue, no revenue, they could be losing money, but there's this promise, right? One of the things that we've talked about before is the KPIs, or the key performance indicators that businesses were measuring at that time, started to shift from, what are your earnings per share in dollars, to how many eyes are on your product, how many people are visiting your website, right? So we do regard those as important measures now. In marketing tools and whatnot, but we don't necessarily factor them into our investment decisions, right? The way that we were back in the 90s. So again, that created the dot-com bubble. We know that bubble burst in 2000, 2001. So that was a whole issue. But if we're just looking at the 90s, we're not looking at the bubble burst at this point. We see this wave of technology, this new innovation of the internet really coming in to change the way people were doing business. Along with that, because of the internet, there was rising labor productivity. So we had higher productivity happening when we could have literal tasks, be done 1,000 times faster because they were being done on a computer, right? Once people started getting used to how we use computers, things started moving so much more quickly in business. One of the great examples that Brad has actually shared on the podcast before was like literally in regards to how trades are placed in the financial industry. Before the internet, you had to call people, you had to submit your tickets and wait for things to happen, right? It was a very manual process. And you could not, right? If you had a whole book of clients, you could not place trades for everyone at the same time. You could not say, all of these accounts hold stock XYZ. I would like to sell all of these stocks in all of these accounts at this time, right? Or at this price. I want to sell them all at $20 per share. I want to sell them all at, 10 a.m. on Friday. You couldn't do that. You had to go through this manual process of getting trades processed by a human. The New York New York Stock Exchange used to have like bustling huge amounts of people on the floor, literally placing trades. Throughout the entire day. That was their whole day. So enter technology, enter computers, and suddenly this whole manual process becomes automated. It becomes more efficient. It becomes easier to navigate, and it actually becomes much, much better for clients as well. Like that's one of the big things for this particular example is that now, you're not, if you're the last one on the trade, the first person who in the book of business who gets to place the trade, they probably get the better price, right? If stocks are falling and you get to be the first one to sell, you're going to get a better price than the person, the last person in the book to get traded. They had a bigger loss and it's a crappier day for them. We don't have to do that anymore, right? We can actually move things very efficiently through the trading process because of the internet. And that really, really came into being in the 90s as well. Um, and then that, of course, applies across the board. Any company in America that utilizes communication across team members, that needs to file documents, to edit documents, to help people understand different things, create presentations, all of that became so much quicker and easier um, with the internet. Disinflation, the other similarity, disinflation in the economy. So, what do we mean by disinflation? We do not mean prices going down necessarily. And when we talk about inflation, I've tried to share this clearly before. Like, disinflation does not mean, again, that prices are coming down. If you look at, a few specific things, specifically gas and food, groceries, different things like that, that do have different kinds of supply chains. Those ones can experience, prices literally coming down, right? So the price of gas can literally come down. We've talked about the price of eggs before. The price of eggs can literally come down. Why is that? Because eggs only last a certain amount of time on the shelf, right? So if you have all your hens laying a bunch of eggs and everything's going smoothly, and you have a million eggs that you have to sell, well, they're only going to be good for a short amount of time. So they have to be priced to sell in that amount of time. Where if you have, the thing that happened earlier this in the business cycle this year, last year, where we had an avian flu go through a lot of the large chicken flocks in America, where a lot of hens had to be culled. Um, now all of a sudden, oh my gosh, we only have, let's say a farm where they had a million eggs a week. Okay, they just had to completely decimate their flock. Now they've got 100,000 eggs per week that they can sell. Well, the price is going to be higher until they can get more chickens up and laying eggs, so they can be back to that million eggs per week. And at that point, they have to sell them at a lower price in order to make sure they're moving through their inventory, right? So the eggs aren't just being completely wasted. Anyway, so those are examples, that and gas are good examples of when we can actually see true price reduction in different areas. What we don't usually see is overall price of costs and goods, overall prices of goods and services coming down. Once we have inflation in one area, typically we're going to keep seeing that number and going higher throughout history, right? So we can think of college education is actually a pretty good example here, unfortunately, where, I can remember back in, 2007 when I would be writing financial plans and doing projections, and, people wanted to know what would it cost to send their child to school. Let's say they had a baby or a 3-year-old in 2007. And they're like, how much do I need to save? How much is college going to cost when my child is 18? So child is 15 years from now. So that's 2022. We're in 2007. What's it going to be in 2022? We would typically use a 5.5% inflation rate. I say we, the practice that I worked with, we would typically use the 5.5% inflation rate on the cost of college education. And that's because that was the historic average over the last, 20 to 30 years on how much college costs had gone up per year. And so we would project this out, and people would see the cost. Okay, maybe in 2007, college at a state school might have cost, $10,000. We'll put a round number on it. Say it cost $10,000 in 2007 per year. Like, okay, how do we make that work? We can do it, save. All right, so 4 years is going to be $40,000. We can do that. Well, no, because when you do 5.5% inflation, so we would do 10,000 times 1.005, and we're going to raise that to the 15th power. That's going to give us a little math trick there to tell us what that cost is going to be. So that in 2007, we were estimating college cost $10,000 per year. Well, in 2022, 15 years later, at 5.5% inflation, that number is $22,324. And if when we talked about this back in 2007 to different clients, it would be like, there's no way. That's crazy. That would be that's crazy. It's going to cost that much. And lo and behold, 2022 rolls around. Yes, absolutely. In fact, $22,000 is low. The average in a lot of state schools is actually around $28,000 in a lot of the projections that I do. That's for a state school. People who want to go, to private schools or Ivy League schools, right? You're looking at $70,000 to $80,000 a year, easy, for the cost of college education. I use this example because it has not gone down. And so if the cost of college disinflates, we might say, okay, it is usually at 5.5%, or it was at 5.5% inflation last year. This year, it's only at 3%. So inflation has come down, right? In this example, that doesn't mean the cost went down. It's just that the rate of inflation rising has come down. And so that is what we are experiencing right now. The rate of rise is coming down, but the cost of goods and services most likely is not. It's just rising at a slower rate. Which again, the Fed, we've talked about this a lot on the podcast, the Fed wants that. They want inflation to be right around 2.5%. That's the stated target and goal, that inflation should be in a healthy economy around 2.5% per year. And so that same thing was happening in the 90s. We were having this disinflationary period where the rate of inflation was slowing down. It wasn't negative. We didn't have negative inflation. We didn't have, that sense of like, oh, things are actually getting cheaper necessarily. But the rate of inflation was slowing down. So in these two graphs, so those are the things that are the similarities that we are experiencing with, the 1990s, which was 30 years ago at this point. So if they're my fellow millennials, the 90s were not 10 years ago, they were 30 years ago. Just FYI, in case that makes you feel extra old. The S&P 500, I also love this picture. The S&P 500 in the 90s was right around 300, like 300 as a level. And now today it's hitting 5,500. So that rate of growth that we've experienced over all of this time, first I want to just really point to that, because that's why we care about long-term investing. That's why we care about having things invested over a long period of time. It's hard to even fathom, right? It's hard to fathom that back in the 90s, when you're like, yay, the S&P 500 just hit 350, or yay, the S&P 500 just hit 400, right? You're like, oh, okay, that's a new high. And then 30 years later, we're talking about 5,500. That's a huge shift. And it goes to show that the rate of growth over time, even when we have these rough periods of, bear markets or recession markets, different things like that, over the long haul, it's very significant growth. So again, what's the what's the rhyming, what's the echo that we're feeling from the 90s is that from about 1994 to, 1997 to 2000, the S&P 500 went from that around 300 level up to over 700, like 750. So it doubled. It more than doubled in that period. It was almost straight up trajectory. Few bumps in the road during that time, but it was a very, very quick rise overall, like relative to what it had been before. And if we look back in 2023 to 2020, 2024, where we are now, we are also experiencing a lot of growth. It's not double, but we've gone from around 4,000 to 5,500. So we're not quite at 50% growth either, but it has been a very, very straight up trajectory. And I would say even in this chart that I'm looking at, there's a red arrow pointing like, okay, here's the growth that we're looking at. I think we could even extend that back to 2022. And then we have seen not quite a doubling, but it's getting closer, which, mimics that line from the 90s even better when we extend that time. So what, experiencing this extreme growth, does that mean, what happened in 2000 when we had the tech bubble burst? People experienced, some rough times with their stock portfolios at that point. Is that what's on the horizon here? I don't know. I don't have a crystal ball. And at the same time, we have actually had some pretty big drops because of COVID, because of inflation. We've had a few rough years here in the beginning of the 2020s. And each recovery has actually been quite fast in relation to the scope of time, right? And in relation to like looking at previous recessions, looking at previous bear markets, the recovery each time has been quick. And so even if we were to experience another downturn, I would be very interested to see if this is a new trend of having faster recoveries, being better able to, be nimble in this, the new economy that we have that is very connected, that is very much online, that has become very adaptable in a lot of ways. The second piece of each of these charts talks about the Fed funds target rate. And again, the reduction in rates. So we're seeing, in the 90s, rates ramped up and up and up. If you look at this chart from 1990 all the way up to, really 1995, the rate went from 3 up to 6, right? So like almost every meeting, they were like, we're raising rates. We're raising rates again. We're raising rates again. We're going to hold steady for a little bit. We're raising rates again. We're going to hold steady. We're going to raise rates. So all the way up from 3 to 6% within, a couple of years, mostly over 1994 to 1995, there was a big ramp up in interest rates. And in 95 is when they started cutting and lowering interest rates, which tends to help buoy the economy. It helps what can be, if they raise interest rates too quickly, it can be a stifle on the economy in a lot of ways. We've talked about this before too. It can really hinder growth because especially smaller companies that kind of rely on business loans, business lines of credit, those interest rates that they're paying when the interest rates are higher, that literally eats into what they're able, their revenue, what they're able to pay out to employees, what they're able to pay themselves as business owners, right? So especially on the mid to smaller end of businesses, those high rates can be difficult to handle. And so we are just now seeing, this is another thing that I think is interesting between these two charts. we are just now starting the interest rate reduction cycle in this, in our period here. Rates were kept high for quite a while. If you look at the charts again, rates have been kept steady since the middle of 2023. So we had more than a year of, about 5.5% on the interest rates. No raises, no reductions, just waiting, 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 waiting. Finally, here this, past September 18th, interest rates were lowered for the first time. And so if we compare that to the 1990s, we can see that, okay, while they were lowering interest rates, there was a lot of growth, like a ton of growth. That was that, 2 times growth that happened. It happened while, they were lowering interest rates, and it basically fueled that bull run. As we continue our journey in reducing interest rates, again, we just had our first cut in September. We're probably going to get the expectation, rather, of the market is that we're going to get another interest rate reduction in November, December, so potentially 2 more. And then also in the spring, in the summer, right, we're going to keep lowering interest rates until we hit about 2.5% as the goal. And so does that extend this bull run again? Is that what we're really seeing? And that's the I don't want to say prediction. I don't really like that word in this space. But there is a good probability that lowering interest rates over time in the way that it's already been communicated to us from, the Fed, could extend this bull market for another couple of years while we are cutting interest rates. So super interested to see if that is indeed what happens. And within that, like I was just talking about before, that recency bias, we are going to have times where we have a rough week or we have a rough month. There could be a black swan event, which, a black swan event is like COVID or 9/11 in the United States, right? Like an event that no one saw coming, that takes everyone by surprise and causes a massive economic disruption of some sort. So there, we could see something like that. There are geopolitical issues still simmering between the Russo-Ukrainian war, Israel and Hamas, right? All of these things are still potentials out there that we are watching and looking at and paying attention to. But as far as interest rates and business cycle go, it is possible that this bull market could keep going for another couple of years. And when we come from that stance, and when we come from the stance of like, hey, remember, since 1990, the S&P 500 has gone from around 300 to around 5,500. If you have time, if you have that kind of time horizon ahead of you, if you're in your 20s, if you're in your 30s, even if you're in your 40s or 50s, right? Parts of your portfolio, it might not be your whole portfolio, but parts of your portfolio are meant for that long term. And so we want to always make sure we have at least a portion that is earmarked for long-term growth as much as possible, right? We want to make sure that we are protecting your ability to continue to fund your life into your 70s, your 80s, your 90s, so that you don't keep everything in extremely conservative investments that, will likely earn from an average of 1 to 5% maybe over your lifetime, because that's likely not going to keep up with inflation. And remember, even when we have disinflation, it means we have less inflation. We don't have no inflation. That's not an expectation that we have. The prices are actually going to come down. the expectation is that hopefully we will just have less inflation that is more manageable with people's incomes, with pay rises, with the amount that employers are able to pay their employees. There are all kinds of other economic factors that go into that that we won't get into at this moment. But keeping inflation around 2.5%, as long as people's pay is able to keep up with that, that's the hope and that's the goal. And from an investment management standpoint, we are looking to um, always stay ahead of inflation with your whole portfolio. So that's a big factor. And if that's not something that you have thought about, if you manage your own finances, if you manage your own money, that's a big factor that I would encourage you to look at and potentially talk to someone about. Right? If you have a financial advisor, like talking about what are we doing, asking that question, what are we doing to protect against inflation long term? How does that look? What are you looking at? Um, what are you doing with the portfolio specifically, right? And it could be as simple as, okay, we have this amount of your portfolio in large cap stocks and mid cap stocks and small cap stocks, and those are predicted to grow at whatever rate is appropriate, probably in that 8 to 12, 15% range. All right, that's the inflation protector. That's your inflation protection on your portfolio, as long as you've got a long time frame to hang on to. So that is the main thing I wanted to talk about today. So kind of simple, and kind of not, I guess. If you have any questions, if this sparked any thoughts for you, if you are interested in seeing more of those, charts or hearing more about any of this, I am always happy to receive your thoughts, receive your feedback. You can get me at Hannah, HANNAH, at expansiveceo.com, or you can leave a comment anywhere that you follow me on socials, LinkedIn, YouTube, Instagram, Facebook, TikTok, all the places. Wherever you find me, you are welcome to send me a message, and I am the one who responds to that. So, um, yeah, get in touch with me. Tell me what you want to hear more about. I am happy to answer questions, and Brad is always happy to answer when he's on as well. So, thanks for joining me, and we will catch you next time. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.